You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Travis Kimmel, the president of Real Vision. Thank you so much for being on the podcast, Travis.
It's great to be here.
Awesome. So I first wanted to start off with your background and your journey to finance, because I believe you were a sort of software entrepreneur before. So could you talk a little bit about, what you did then with GetPrime, how you sort of switched into finance from sort of being a tech bro to a finance bro?
Yeah. So I got a philosophy degree from college, which was tons of fun, but also not immediately useful. And so figured out I should go, find a craft, got into software from that, because there's actually a lot of overlap between some of the like symbolic logic stuff that you learn in a philosophy degree and coding. So I kind of took to that, worked for a guy out of Boulder for a while, building websites, started my own little company, and then eventually got sort of drafted into a startup out of Denver, where I was running a team of software engineers, and that was pretty fun. I noticed during that time that the tooling for managers around software engineering was not that great, and so after a while broke off and started a company with a friend of mine, a software company based out of Durango, which everyone told us would not work, which was great entrepreneurial fuel, because you always want to have someone to prove wrong. And raised a bunch of money, spent about 4.5 years doing that. And then we sold to this cool company out of Salt Lake. Spent about 1.5 years there doing integration stuff. And during that time, started getting really interested in finance. And finance is interesting from a couple perspectives. One, it's kind of, the other group of nerds who are not software engineers figured out how to be successfully productive nerds in the world and earn a living doing that. And then the other thing that I really like about it is that it's this kind of infinitely deep well. Like you can keep learning about it forever. And, the game just gets bigger and bigger and bigger, as you well know. And that was kind of my intro to finance. I went on Reddit and decided there's this subreddit that aggregates all of the hedge fund letters. So I was like, I'm just going to read all these hedge fund letters going back for like a year and see if I can understand what they're talking about. And
is that r/security analysis? Is that the one?
Yes.
Yes.
I love that one.
Yeah.
Super interesting stuff on there. And so read a bunch of those, quickly realized that no, I could not understand them. And then found Real Vision in an attempt to correct that lack of understanding. Got really into learning about macro, and then eventually connected with Raul and came on board to help take it to the next level.
Got it. So, when you go on security analysis, most of the letters are sort of, value investing, people trying to find undervalued companies, etc. So, how did you decide to make the shift from sort of understanding, value investing to more of the macro style of investing?
I guess value investing is super interesting stuff. I still am really, really very interested in that. The thing that was useful about starting to learn macro is that it seems like the value of value investing as an approach is itself sort of cyclical. And we appear to not be in one of those cycles, as much to the chagrin of value investors everywhere. We appear to be in another part of the cycle where, growth and things like that are doing well. And then in an effort to learn why, macro sort of came up. And then eventually also learning about like market structure, because I think that's also a huge component of what's going on right now is, you have all of this volatility trading that really kind of becomes the tail that wags the dog when there's enough of it going on.
Yeah. And, when you were at GetPrime, you sort of joined the Y Combinator thing with Paul Graham. So could you talk a little bit about that? How you got into Y Combinator? What Paul Graham
Yeah,
is like? I'm a bit of
yeah.
a Paul Graham fanboy, so
Everybody should be a Paul Graham fanboy. He's awesome. Yeah, so Y Combinator is really wild. It's very cool. The best way that I would describe it is it's sort of like, I didn't go to like an Ivy League school. And if you do that, you get a bunch of really awesome connections that are super valuable. Y Combinator, if you get in, is sort of like an instant network like that. So
right.
there's a bunch of other entrepreneurs who are typically right around your stage who are running into the same problems. And it's a great network of fellow entrepreneurs. Like as an example, we had started this software company and knew nothing about sales. So we were just trying to hustle and ran into this guy who was like, yeah, we're sending outbound emails. We're just doing like cold calling via email, which had never even really occurred to us. And we started doing that, and it led us down this really journey of like really extremely high touch, cold outreach emails that was super successful. And we just kept getting, more and more of these really ripping ideas like that helped us scale. And they bring in a bunch of they give you a lot of access as well. So they'll bring in, like the founders of Airbnb to talk about their startup, and they'll give an hour talk and then sort of an open Q&A. It's really cool. And I would say, it's common for VCs and sources of funding, which Y Combinator is, because you get a little check of seed money along with that. It's common for them to say that they're really founder friendly, but Y Combinator is like one of the most absolutely founder friendly organizations ever. I mean, they really have your back. So we're lucky to get in there.
Right. So do you know Brian Chesky?
No, not personally. I mean,
Okay.
he wouldn't remember me. I've met him in passing in a room with like 100 other people.
Right. So let's get into your rather, as you call them, questionable opinions. And now I wanted to start off with a non-financial questionable opinion, and that is, why do you think philosophy degrees are actually valuable? A lot of people, if you're going to college, they would say,
Yeah.
don't go into philosophy, either study, say, computer science or get a BBA or something like that. So why are philosophy degrees valuable?
I think the value of a philosophy degree is that it teaches you how to be disciplined in your thinking. So it depends a lot on the style of philosophy. There's two dominant traditions. One is the continental tradition, which is like, Nietzsche and Hegel and all that stuff's fascinating. I didn't focus a ton on that. The school that I went to was more of the analytical tradition. And so, we studied a lot of, it's sort of like words as weapons. It's how to construct a really tight argument and or break down an argument that has flaws in it. I found that whole thing fascinating, as you can probably tell from my Twitter presence. It's still a hobby, but I really like the approach of learning how to think in a way that mattered, because thoughts are cheap. Like everybody has thoughts, but if you can figure out how to create thoughts that have impact on the world because they're stable and they have better structure, that's kind of what a philosophy degree does. And I think, for a long time, I sort of laughed about having a philosophy degree. I loved doing it. I didn't think it was that applicable. And the deeper I've gotten into my career, the more I realized it's pretty good. It doesn't give you a trade right out of school, and that's the downside.
Yeah.
Something like CS does, and that's fantastic. And those degrees are also really good. But I think there's still a place for the, learn how to think.
And you've probably read about George Soros using philosophy and Karl Popper's ideas to build hypotheses, and you probably were attracted to that.
Yeah, absolutely. Very, very into like the big thinkers in finance.
Absolutely. Now let's get more into sort of the more finance topics. And so I want to start off by talking about inflation and the thesis or the reflation trade as it's become known. So now, number one, why is the reflation trade wrong? What's going on? What did the people who believe in reflation have wrong fundamentally?
Yeah, so first off, it's not wrong yet. I mean, they're doing pretty well.
Yeah.
But I think over the long haul, there are a couple different ways to think about how inflation happens. And you look out there and you see people sort of talking about it. And one view is that it's all about the supply side of money. And if you increase the amount of money in circulation, then you'll get inflation. And I think that, that's not, like most things, it's not untrue, but I don't think it's the whole truth. Because one of the interesting things about our economy is we create debt-based money. And so debt-based money is both a supply and demand artifact. Like when you create $1 of debt, you've also created $1 of $1 of future demand.
Yeah.
So you've created $1 of dollar supply, and you've created $1 of future dollar demand, and even then a little bit more, because you have to pay interest on that. So as you're increasing the money supply via debt, you are also ramping the demand side of the future demand side of dollars. And so there's a way in which that method of running a money supply, it prevents hyperinflation, because you have this demand pair with the supply. But you can also get these pulses where, like, if you create a ton of debt out of nowhere, for a while, that demand is lagged into the future before it hits. So I think right now, one of the things that's happening is we have created a bunch of debt all at once, and you are seeing these price distortions as a result, that money has to flow into things. But over time, I don't think that it's structurally inflationary in the way people think. And one of the reasons is that we already had a lot of debt. Like, we are loaded with debt. The private sector has debt, the public sector has debt, the government has debt, and all that debt needs to be serviced. Government debt's a little different, but when you have a lot of private and public sector debt, you have this constant demand pressure for dollars. And there's international debt, there's euro dollar debt, and as you build that sort of crushing demand for dollars, it becomes this process of kind of kicking the can down the road. And if you can't issue enough debt, new debt, you will run into the opposite problem, where you have all this sort of demand for dollars coming in, and there's not an equal ramping of supply at that point in time. I've always found it useful, once I started to understand this stuff, to think of money as temporal. And one of the best ways to measure supply relative to demand is the yield curve, right? It shows you points in the future where people think that there's not enough money. And when you get a yield curve inversion, it's actually pointing to a thin spot in the future of money supply. So I think one of the things that has happened recently is that, that money does have to flow into somewhere. It also has to get paid back. And businesses are getting destroyed. Like, there is a lot of the revenue generation potential in the economy is getting crushed. Right. Small businesses are closing. There's a lot of revenue that hasn't been booked because people aren't eating out. The service sector is getting hit particularly hard. And when we look at CPI, you unpack that thing, and service sector has been pretty mangled. People buying stuff is actually up. And what I believe that represents is a transfer of capital people had into buying things, but that also reduces the future demand for things, because you've pulled forward a lot of this consumption. Like, if you buy an exercise machine because the gym's closed, you're not going to need another one next year. So I think we're in this period of time where there's been a fair amount of consumption via transfers. We're looking at the CPI and thinking everything's okay, but in the future, we actually have kind of weakened the demand for things, and the service sector is still kind of weak. So the revenue generation potential is not great. And when we look at what customers are doing, there's not a ton of new customer debt, right? People are a little nervous, so they're not loading up their credit cards, and they're paying down their credit cards. So even if you create money through, government transfers or whatever, but that money just goes to feed the immediate dollar demand of debt, it's not clear that that's inflationary. It's not clear that as a practical matter, the active supply of money is increasing. And that stuff can be measured through, like velocity of money. What you really want to see if you're an inflationist is the velocity of money go up. And we have not seen that meaningfully yet. So I think for sustained structural inflation, we'll want to see velocity start to rip, which we may see.
Right. And, could you sort of also talk about why the money supply is not really money supply in the way people think it is. And a lot of people try to confuse what QE is with actually increasing the money supply. So could you explain why that is not so?
Yes, QE is a clever thing. I watched this video from Warren Mosler. I think is such a fascinating thinker. He really understands
Absolutely.
the gears of the money supply,
Right.
and he explains it as treasury bonds they're sort of like a savings account at the Fed, right? And when you take those treasuries and you you buy them from the market, which is what QE is, you're really just shifting the duration of money around. So if I hold a 30-year treasury, what that means is I'll get paid a little yield along the way, and then in 30 years, I'll get the amount of money that the basis of the bond back. So if it's $100 worth of 30 years, I'll make whatever it is these days, 1.6% or something, for those 30 years, and then I'll get the money that I put in out. And so the value of these bonds is that it allows big actors to kind of think about money. Like if you need money 3 months out, you can buy a 3-month bond, get a little bit of a yield on it, and then use that money when it's needed.
Yeah.
And so when we do QE, what we're really doing is taking this sort of future money and pulling it into now. And that does have a liquidity effect, right? Like
Yeah.
it increases the amount of hot money, right? That's sort of zero duration money in the economy, but it's not strictly speaking a net increase in the amount of money. It just sort of frees it up into the now moment. And people have varying views on QE, but there are times when you look at the economy, it's like, yeah, we actually do need a bunch more now money right now because we're in the middle of a liquidity crisis. And so QE is an attempt to solve that liquidity crisis by just making sure that there's enough kind of, blood in the body at that time, and we don't starve to death from just sort of lack of lubricant in the system. Now, I think critics would say it also creates these really psychotic price distortions, and I think that is probably correct, because when you take a bunch of money that was imprisoned in time and you bring it into the now, people are going to spend it on stuff, and they're largely going to spend it on assets. And so what we see is this people talk about asset inflation, which I don't know if that's a real thing or not, but what we see is that the price of assets increasing because people are looking for a place to park that capital that was sort of frozen in bonds.
Yeah. And when that is sort of combined with the act of reducing interest rates, I think together they sort of increase asset prices, and lower interest rates also have their part to play, because in the Black-Scholes model, if you have lower interest rates, options sort of become cheaper, and more people would buy those options. And and you mentioned that before, sort of the volatility driven buying that's going on in the market right now.
Yeah, totally. Everything gets cheaper in the now. And that time piece of money is really important to understand. So, part of what low interest rates do is they allow people to pay more for things because the monthly payment that they're paying is less. Yeah. So if you're paying, 20% interest for a house, which we had, really high rates back in sort of late 70s. If you have to service debt at that rate, the amount that you can afford to pay for a house is just lower. Yeah. So you see asset prices lower in these high rate environments. And then as you continually press the interest rate down, it changes the calculus for an individual actor who's buying something on margin. Yeah. And there are, a multitude of things you can buy on margin. There's the things that we all know about, like houses and cars and whatever else. But it also affects, all variants of margin, including stocks and all that.
Right. So, about 4.5 hours before we spoke, the U.S. got a new president, Joe Biden. And, a lot of people have been saying that the Biden administration's policies are going to be, it's going to be more stimulus, and therefore it's going to cause more inflation. So do you think that, number one, there's going to be inflation if we have more stimulus? And then the other thing is, if there is no stimulus, what do you think the impact on the markets is going to be?
On the first one, if we get stimulus, I think it depends on how we use it. I mean, there's different ways to allocate those dollars. If we're just kind of shotgunning them out there to people directly, then it depends on what they do with it. Like, are they taking that and paying down debt because they are unemployed? If that's the case, I don't see that as particularly inflationary in the near term. Now, over the long term, people, they'll have more debt capacity once the economy recovers, and you could see some inflation as a result of that, as a result of people taking on more debt. If we were to take that money and spend it on infrastructure projects, that could be inflationary with regard to materials. So if we decide, if Biden says we're doing this green energy thing, and we're just going to roll out, everyone gets solar on their house. Let's imagine he did something like that, right? Yeah. Then you would expect to see some serious inflationary pressures. I mean, you just ramp demand in this specific sector, and you'd expect to see, the materials that are used to create solar skyrocket. Yeah. So to my mind, it's more about how the policy is deployed than it is like the raw amount of money being introduced into the system.
Got it. So I wanted to move on to another very important topic, which is crypto. And I first wanted to start off with your famous the crypto that you are very well known for, and that's Tether. So now, so I want to ask you to explain and expand on, what are your thoughts on Tether? What's going on?
Yeah. So I would start by saying, look, I've always thought crypto is really exciting tech. Yeah. I'm a tech guy, and I think that the fact that we have a new idea about how financial markets could work is super exciting. Then inside that idea, people are replicating, they're replicating old financial tropes in this new system. And one of those financial tropes is like gold, hard money, right? And you see that in Bitcoin. Bitcoin is designed to be a scarce store of value. And I think that there may be some merit to that. I still have open questions about how that looks over a long period of time. There's a need to fund the system. So Bitcoin is run, the Bitcoin network is run by these miners who get sort of paid. And in Bitcoin, and in order to fund the cost of mining, they need to sell some of that so they can pay their electricity bills, which are at this point still paid in fiat. So there's a constant kind of sell pressure in the network, but the supply constraint coupled with increased demand from institutionals can definitely cause the price to rip. Like, that totally makes sense to me. It effectively works like a lot of commodity markets work, except with Bitcoin, you have a really tightly defined supply. The thing that Tether introduces into that whole ecosystem, Tether is basically a stable coin. So Tether it's almost an attempt to replicate fiat, right? It's basically take some fiat and put it on these crypto rails so that instead of me, if I want to wire you, $1,000, instead of me having to go down to the bank and pay a fee for that and then wait 5 business days or whatever it is, I guess a wire is faster, it's 24 hours. Bitcoin and stable coins allow that to be functionally instant. Yeah. And so the promise of stable coins is this, transnational, cross-border, better way to send money all over the world. Yeah. And I think that has promise. I think stable coins are super interesting. I would expect to see stable coin adoption in some form. The curious thing about Tether is that they have yet, in my view, they have yet to produce a compelling audit. So if you're introducing a token, I mean, opinions vary on this stuff, right? It's a very charged topic. But if the reason that you're buying a Tether is because it's worth $1 and you can ship that dollar anywhere in the world, that's awesome. You've got a better shipping container. But if you open up that shipping container and there's nothing in it, I mean, that's a little weird. So I think what we'd like to see from all stable coins is a set of standards and practices around how they disclose what backs the stable coin and how people can know that it's actually worth $1, that they're actually getting $1.
But isn't that true for all cryptocurrencies? Like, there's nothing backing it because, basically all cryptocurrencies are just lines of code.
Yes and no. I mean, if you look at, there are stable coins that have sort of better proof of backing, and I think those have a lot of merit. I think that, again, that's just something riding in a fancy new container that's faster. Like, we took our old VW and we upgraded it to a Ferrari, and that's awesome. I think what critics of Tether worry about is that if these tethers are being minted without the need to source fiat from the ecosystem, then they are an unconstrained form of money printing.
Yeah.
True money printing in a way that QE is not, because you are not, with something like Tether, it's not like you're pulling forward a future duration tether. You're just making more of them.
Yeah.
And so if we're not sourcing assets from the market to back that, then you have this unconstrained sort of perceptual store of value, which can increase the total amount of money in the system, as long as everyone accepts that it's worth that, to a level that is really just kind of rocket fuel. And so I think the Tether skeptics, we sort of wonder whether or how much of that is going on, because we really don't know. There's no way to know. It's not a positive thesis that something weird is going on. It is a concern about lack of proof that nothing weird is going on. and I think that Tether critics would ask the question, how much of Bitcoin's price is from this printing of tethers that are questionably backed into the crypto ecosystem, which can then be used to run the price up. And this is it's really not a knock on any specific group of individuals. I don't really tend to favor those. I don't think they do anybody any good. It's more a desire to see a common set of standards and practices around what a stablecoin is, so that we know we can trust it. Because this crypto ecosystem evolved as a distributed trust ecosystem, and an important part of that is verifying that the thing is what we think it is.
Absolutely.
Now, in Bitcoin's case, that's actually a little less relevant.
Yeah.
Yes, it's not backed by anything, but it's sort of it's backed by belief, like a lot of things.
Yeah.
And I think that's fine. But if it turns out it's backed by belief and some like weird price juicing, those things have a tendency to unwind rather explosively.
Yeah, absolutely. A good way to sort of visualize the tether problem is, you could think of it as a gold standard, but just using dollars. When you had the gold standard, you sort of had one gold bar for $1 or whatever the ratio was. And similarly here, you're supposed to have one tether for each US dollar. But now, if people just print more and more tether, you're probably going to end up with a lot of problems.
Yeah. And one of the complaints from people who favor hard money backing for money is that it provides this constraint on the system, so that we don't issue too much, and so that we don't water down. Oftentimes hard money advocates are a fan of the idea that fiat money should not degenerate over time in value.
Right.
I think there's merits on both sides of that argument from the perspective of whether we want that. But if you want it not to compost in value over time, then you would also want to make sure that you're not debasing cryptocurrencies that have the ability to affect that ecosystem, because at some point, people are going to want actual fiat out of Bitcoin. Again, some people disagree on that, but if nothing else, you got to pay your taxes. This is why there's demand for fiat. It's because you need to pay capital gains tax and you need to pay income tax. And so at some point, when people realize a bunch of gains in Bitcoin, they're going to need to take a portion of that out.
Absolutely.
To render unto Caesar. And at that point, I don't really know what happens if there's not enough ability to extract fiat from the system.
Right. And on that note, I wanted to move to Bitcoin, and sort of, you're very brave on Twitter to go on all the on all the Bitcoin bulls and say that they're wrong. And so I wanted to talk about Bitcoin and then ask your view on it. You're not particularly bullish on Bitcoin, as I understand it. So why? What is your thesis behind Bitcoin? What's going on? And are you having fun staying poor?
I have a funny history with Bitcoin. I bought a bunch when it was like 10 cents. And then we went to, I think like $300 is where I sold. Not a bunch. I bought like $10 worth, and then it went to $300. And at that time I was a starving entrepreneur, and having cashing that out and, using it to put food on the table seemed pretty attractive. So I did. No regrets about that, because at the time the money was more valuable.
Yeah.
And then got back into it kind of early in, probably early to mid 2020. I definitely bought that big March dip, but I also had some before that. I didn't time it perfectly or anything. I was pretty attracted to that stock to flow model initially. Sort of interested in that, and independent of whether that specific model was accurate, I could definitely see that there was increasing interest against a reduction in supply. And that's just, basic commodity market stuff. So it seemed like it was a good bet. Then in, I think late November, early December, I started going down the Tether rabbit hole and realized, it wasn't really a thought that it would go down. It wasn't like a positive bear case. It was more me realizing that I had not properly understood the trade.
Yeah.
And that there were a lot of other dynamics in play that I didn't quite understand. I had already had a tidy profit on it. And so just sold it, got out of the trade in order to investigate stuff more. And my investigations led me to Twitter. And if you question the glory of Bitcoin on Twitter, you are met with some rather persistent negativity about why you would dare do that. And the more that I got into that debate, the more I saw some of those same philosophical flaws in the thinking, right? Like the thing that worries me about Bitcoin is that there is a lot of unsound thinking going on in the space. So that's a really weird put out there as a risk, but I still, it could be my philosophical bias and history there, but I still always worry that when, if you're using an unsound argument to make a case for a thing, sometimes that can blow up in your face. And so, I have a ton of questions about Bitcoin still. I'm still poking away at that. And I think one of the most interesting characteristics is this idea that you have this constant sell pressure, right?
Yeah.
Like in the end, I think it functions a lot like a negative yielding bond in aggregate as an asset class. Right. So you have this big pool of Bitcoin, and from that pool, there needs to be this sort of tithe to fund the electrical costs of running the network. Yeah. So I would expect that this thing will, it'll run up as long as there's more interest than there is supply. Supply is still pretty thin. Everyone likes to promote this idea of just holding it forever. And so that thins the market more and more and more. And I expect it may continue to run for a while. And then at some point, people will decide that they want to take that value and convert it into real world stuff, like a car or a house.
Yeah.
And at that point, if you get more sellers than buyers, I think you could kind of see the bottom fall out of this thing again. Right. And I'm not particularly good at timing it. So, I slunk off into the bond market where the trades are big and slow. And if you're wrong and you don't get the timing perfectly right, it's not like, as long as you're not levering it up, it's not a big deal. Like maybe you're up or down a few percent. It also means, it blunts the return profile as well. You're not making sick gains. I'm not driving a Lambo, but right. I'm fine with that.
Right. And you probably have like a similar view on gold, especially, with what we spoke about earlier, where there is no inflation, and I can see a safe behind you. And does that have gold inside?
It actually, we should do like a safe opening. I don't even know if I remember the combination of that thing. It was, that was where we stored our petty cash back in the day, which is so funny. Gold's really interesting. I think gold's grown on me a little bit. I think gold is one of those things that's, there's a time to buy it, and the time is probably always. Like you just buy a little bit, keep it around. I think it's a really interesting asset from the perspective of portfolio construction. Right. For me, one of the things I look at is you look back at this 2008 period, and there was a point where there's a big shakeup, gold kind of dropped off, bonds went way up, and some of that stuff is driven by the narrative around gold and real rates. And so real rates are, the delta between inflation and what the bond market pays. So if the bond market's paying 1%, inflation's at 2%, you have a negative 1% real rate.
Yeah.
And in those environments, gold does really well. I mean, that's part of why it did really well recently.
Right.
I would worry that we are heading into a period where some of those CPI elements that we talked about will fall off because of the structural damage to the economy, and that will reverse this real rates dynamic. And I don't think gold will do particularly well during that, which I look forward to because I will probably buy some.
Yeah, and you're pretty well known for your brave boy trades, short tech, long bonds, long the dollar.
Yep.
So how do you
Yep.
sort of time these trades? Do I've seen your post technical charts, but how do you use them? Do you just use typical chart patterns? What do you look
Yeah.
at before you place a trade?
Oh, well, as anybody who's been on Twitter knows, I'm not the world's best technical trader. I think that to my mind, the goal of technical trading is to give you a read on where market sentiment is at. Like people, herd behavior follows these sort of similar patterns, and you can get a sense of the aggregate emotional state of the market by looking for those patterns in the charts. They're not predictive in the way everyone wants them to be. It's not an oracle, but it can give you some really good signal about how people's opinions of an asset are changing over time. So I really like that. I like putting them on Twitter for discussion, kind of seeing, what other people think of that read. And in general, I think that they're really useful as a timing tool, or how I use them as a timing tool for something that I have a bigger, broader macro thesis on. So, I don't really like to trade short stuff, short duration stuff. Like a short duration trade for me would be like 3 to 6 months. And a longer duration would be, 2 to 10 years. And so I prefer to find these trades that I think are being driven by big structural forces and gravity, and then get into them at what seem like opportune times, and then wait and just wait for those structural forces to play out. And in the end, it ends up being a little bit more like portfolio construction than it does trading. Like a trade that's about a year, that's a long trade. It's really more just like an allocation to an asset class. And so that tends to be how I think about it a little bit more.
Got it. When you work with people like Rahul Pal, so how much do you sort of buy into a lot of sort of the Bitcoin bull, the insolvency crisis? Do you believe that we are headed towards an insolvency crisis where all these long bonds, long the dollar, all those trades are going to eventually come good, or what is your opinion on it?
Yeah, I do. Rahul's been doing this a long time, and I take everything he says very seriously. I think he's particularly good at reading emergent narratives and sort of getting into the wave early. Like you're out there in the ocean and you're looking for the wave to ride, and you see a good one coming. That's kind of he's very good at that. He can read sentiment and read these sort of nascent waveforms in a way that's awesome. I think a lot of good macro traders are all about that. In terms of the insolvency phase, I just look outside and walk around downtown. I can see it. I mean, we're in it. And at the moment, there's a whole slew of policy measures that have been put into place to kind of blunt the pain. Everything from mortgage forbearance to, direct transfer payments, like the government's helping people out to get through this time, since we've asked everyone to stay indoors. And that does blunt the pain for sure. But we're already in the middle of the insolvency crisis. Like I can name a handful of restaurants in our little town alone that are out of business.
Yeah.
And, you read these stories of businesses shutting their doors. People are behind on rent. I mean, we are in the middle of the insolvency phase. We just haven't felt it yet. And I do think that will play out. And I think as it does, the value of having money will increase, and bonds are just a temporal form of money. So I think they're a good bet here.
And could you explain why, when businesses are going bankrupt and people can't pay the rent, why are stocks at all-time highs?
Yeah, this is a weird scene. I'm not entirely sure. I think part of that may be people are getting a little ahead of themselves with regard to the recovery.
Right.
So,
Yeah.
so I think that the reflation thesis is probably right, but also probably early. And I think a lot of what people are doing is looking forward to this time where we pull out of COVID, and as a result of transfer payments and sort of the government splashing cash around, things will take off. I just don't buy that, because the money engine for a lot of people, whether it's their business or their job or whatever, has been really crippled.
Yeah.
And it takes a while to rebuild those sort of fundamental economic engines, which there's a ton of all throughout America. One of the great things about America is we have a lot of small business, and it's just a really rich and robust economy. And some of that robustness has been seriously damaged. And Americans are really great at entrepreneurship, and I do think we recover, and I do think we pull out of it. But I think we may start to see some of the damage show up in earnings in ways that people will have to react to, because these companies are worth less. The reason you invest in a company is to get a share of the profits. And when those profits decline, the stock's worth less. Right. And right now, everyone is sort of forecasting a time when they will eventually improve. But if we go through a whole year here where everyone's feeling the insolvency, that stuff will start to sink in. And there's not a lot of room for stocks to keep ripping. Now, it doesn't mean they couldn't go up another 20% before we get there, but eventually reality sort of sets in and these things get repriced.
Right. And, I wanted to stay on that note for a minute. When we think of a recovery, what market sectors and industries do you see destined for growth in a post-COVID world and are under a Biden administration?
I think that I would agree with a lot of the big macro minds on that. I mean, there does seem to be a consensus about what the trade to get into will be, which is, commodities, emerging markets. Emerging market economies are largely driven by commodities, so they kind of work hand in hand. I think that those are all the right calls, but I just don't quite buy into the notion that we can skip forward to the happy days without ever feeling the pain. I mean, maybe I'm wrong on that. Maybe the Fed's cracked it. Maybe, all these things, these transfer payments will allow us to just sort of skate through this little rough patch, but it's the biggest rough patch I've ever seen in my life. So I just have a hard time buying the idea that, between here and the time when those trades get really good, there's not a big giant heap of pain. So I think, look to emerging markets, look to commodity stuff that's interesting. It's a good time to start building a shopping list for that stuff, even if you're not into it yet. So I eagerly await favorable prices.
And you probably agree, with a lot of the dollar bulls that once we see a spike in the dollar, after that, we're sort of going to see what George Soros would call, I think, was a vicious cycle, or the cycle where things go down, where the dollar will go down over the next decade. So would you agree with that?
I'm not sure yet. I'm still early in my thinking there. I do think that we will, the dollar bull trade is basically the everything bear trade. I mean, you're sort of saying that in aggregate, everything will be worth less relative to the dollar. Yeah. And there's different ways to express that. Sometimes people are doing it versus other currencies, and that stuff gets really complex really fast. But I do think dollars will become much more valuable as the insolvency stuff plays out, and we'll return to that kind of cash is king phase for a bit. After that, I'm not really sure yet. That's one of those areas where I think you kind of just have to watch and wait and see how much the dollar spikes. Like if it spikes enough, then of course, yes, it'll revert. If it's sort of a modest spike, I don't really know. The thing could just go sideways for a while.
Yeah, absolutely. So I've got two more questions for you.
Cool.
Yeah. So what is the likelihood that Tether is a foreign actor who's applying a levered USD short?
Oh my gosh. I would not know how to price that. Let's talk abstractly about it. Look, I have no information on that. and I don't even know how one would get that. But I think that a lack of regulation certainly breeds predators. I mean, the reason that we have regulation is to limit predation on people who are in the markets. So it doesn't seem unreasonable to me that some of that might be going on. As to what nation state it could be. I mean, we know it could be us. It could be. I have no idea. But I think that I had made a joke the other day that's like, if you're walking through a rough part of town and you see an ATM made of glass, at some point someone's going to notice that, and you've got a bunch of sort of offshore, stuff that's not protected by regulation. Right. So I think it makes a juicy target, but I don't really have any info on, whether or not any of that's going on.
And to wrap up the podcast, what is the best culinary herb and why is it cilantro?
Oh, cilantro is so foul. It's like adding soap to your food. I've been informed on Twitter that is a genetically informed opinion. So apparently I got the cilantro is gross gene.
Awesome. Thank you so much for being on the podcast, Travis.
Yeah, thank you.